You are listening to a special preview of the KE Report Weekend Show with your hosts, Corey Fleck and Al Corlin. This preview is brought to you by our friends at goldeagle.com. To listen to the full 2-hour weekend show, please visit www.kereport.com on Saturday morning. Welcome in. You are listening to the weekend edition of the KE Report. Al is not going to be with us for the first couple segments, but that's okay because we have a great show lined up for you. We're bringing back Trader's Corner to kick off the second hour of this week. We're also going to have some other great analysts, including who I'm kicking off the show with, Peter Boockvar, Chief Market Analyst over at the Lindsay Group. Peter, thanks for starting this segment and next segment off with us.
Thank you, Corey.
Peter, let's get right into it. What's been in the news throughout this week, even second half of last week, and that is what the Fed is going to do in terms of rate hikes, but more specifically, all the Fed speeches. This week, we saw a ton of Fed presidents be marched out, including Janet Yellen at the tail end of the week. But the overall narrative, ever since we saw the minutes from last month's Fed meeting, has been a shift in the potential of a rate hike coming on the table next month. Although, as we're recording this, I think the expectation is right in between about 30 and 40%. That's up quite a bit from last week. Where do you stand generally on this right now, Peter?
Well, the Fed's in this unusual bind in that if you looked at the data and you saw a 5% unemployment rate, you saw core CPI, even though the Fed looks at PCE, but core CPI at 2.1%, and you'd say, and the S&P 500 near record highs, how can the Fed funds rate be at 37.5 basis points? But on the other hand, you look at manufacturing, which is flatlining, corporate earnings are now declining. You have GDP growth in 2016 likely to be under 2%, and you say, well, how can the Fed be hiking? And from listening to these Fed members, they seem to be much more optimistic about growth and the ability of reaching their 2% target because they've already said they've reached their employment mandate, that they further want to separate themselves from a zero interest rate. And I think the talk from some of, we'll raise 2 to 3 to 4 more times this year is nonsense because I don't think the economy can handle it. But it certainly seems clear that they want to raise again. June, of course, is right before the UK vote, so it's likely that they maybe hold off before that. But then they'd want to raise in July because that gives them another hike under their belt, and it's far away enough from the election that they won't get into the political dirt related to that.
There's so many questions out there, aren't there, Peter, because there's so many different factors. Just like you mentioned, that Brexit vote coming a week after this upcoming meeting, and then also the election coming down the road. Do you think the Fed is, or at least wants to raise rates for either A, the ability to cut rates later on down the road, but I think that would be much later, or just for the mentality of getting out of this free money that seems to be on every investor's mind?
Well, I think it's a combination of that, and I think also, they're running models. They're seeing that if commodity prices have stopped going down, which it looks like it clearly has, combined with 3% services inflation, they're going to have headline inflation in the back half of this year approaching 2%. So they don't want to get stuck by year end with all their mandates met, and they're still stuck at, again, 37 basis points or even, let's just say, 62.5 basis points. It's a really bad position to be in, and I think they want to get away from that. For 7 years into a recovery, and now they're deciding, okay, it's time, is of course pretty pathetic. The jobs picture in 2013, I think we were averaging 2014, we're averaging 250,000 jobs a month. Last year, we were averaging it's about 200, and now this year we're below 200. So now in their infinite wisdom, they think, okay, now's the right time to do this. But I think also that, they don't want to get trapped. I think they don't want to be trapped like the Japanese did, and they're going to do their best and find every excuse now to get out of it, whereas before they were using every excuse not to raise rates.
Now, what about these inflation expectations? Because I remember talking to you, it must have been over a year ago, maybe even a year and a half ago, beginning of 2015, when you said, yeah, inflation definitely isn't really on the table now, but when commodities start to bottom and even just move sideways, that's going to make a big difference in their inflation expectations and equation that they use, simply because we went through a period of 4 or 5 years of decreasing commodities. We are seeing so far this year a bit more of a bottoming. We all know the precious metals have done fairly well, but even the base metals, at least they're not falling. So do you think later on this year inflation is going to pick up?
I think just based on the math of recycling out the sharp declines, it will in itself raise headline inflation. And the problem the Fed has is services inflation remaining very sticky. Of course, a lot of it's due to rent and medical care, but we saw in the CPI last week, services inflation ex energy up 3%. And now the declines in energy prices are shrinking. And by the back half of this year, may actually be flattening out. So I think the Fed and listen, we all know the Fed focuses on rate of change here. It doesn't look at the absolute level of CPI. The absolute level of CPI, is near record highs. It's the rate of change that they obsess on, and this 2% target. And based on rate of change, they're going to get to their target in the back half of this year. I don't think they want to be raising rates near the election, and I think that's why they're itching to do it well before it, so they can't get blamed for anything. Now, that said, if we go into recession and the market falls a lot, they'll certainly get blamed by the Democrats. But on the other hand, if we had 2% inflation in the back half of this year, you'd have the Republicans saying, how come the Fed's not raising rates? They want to give the election to the other side. So it's a politically very difficult situation. And again, I think that's why they're trying to do this sooner rather than later.
Now, as for some of these data points that the Fed is looking at, the data points have actually been moving further and further in their favor, but the Fed has expressed concerns over, first of all, countries around the world that continue to struggle, especially in Europe, even concerns out of China, but also on the domestic markets. Do you think the Fed is still going to keep these in mind, and these could be some reasons why they push back a rate hike if they don't do it?
I mean, the Fed, we can be rational, but when you're dealing with PhD economists, they're very much wedded to their models. And their models see labor market that's tightening, but that's not necessarily good for growth because productivity has been slow, or it's been slowing to almost nothing. And the inflation statistics are moving up, and international developments, which they've cited in the past, are calming down. But at the same time, GDP growth is now less than 2%. Corporate profits are now shrinking, and that's obviously a precursor to a future slowdown in capital spending and potential hiring. So if you look at the Fed models, it's keeping out some of these other things and focused on them meeting their mandate. So they're stuck in this really weird. I mean, when you take a step back, manufacturing is flatlining, and GDP growth is going to be less than 2%, and the Fed's ready to raise interest rates. But again, we're in uncharted monetary fantasy land, and things don't always have to make sense.
Now, Peter, before we need to take a break here in about a minute, the recent moves in the U.S. dollar, how do you feel the Fed narrative is affecting this, and also the charting position, almost a technical trade, for when the U.S. dollar dropped below 92 points on the index?
I mean, I get the dollar index rally. I mean, if people think the Fed's now going to be raising rates, okay, buy the dollar. But the dollar index is still 5 points away from a high it touched in March 2015. We're more than a year from the high, and the Fed's about to raise a second time. So, any tape watcher should say, you know what, maybe this dollar bullishness doesn't have as firm a basis as I previously thought. I'm not thinking that the Fed's going to be on this multi rate hike cycle this year and next, because I think we're going to run into economic and market trouble again on another rate hike. And I think the U.S. economy at this stage of the cycle is bordering on recession, and that's certainly not dollar positive. So I would fade this dollar rally. Again, I understand it in the context of the Fed raising rates, but I would be fading it. I think that we're more than a year away from a dollar peak and on the cusp of a second rate hike says a lot about what people think about the U.S. dollar.
All right, Peter, we're going to be right back with you for another segment talking about recession concerns and some more in-depth coverage on the U.S. markets. Everyone stick around. We're going to be right back.